Welcome to the Financial Modeling Podcast, where we discuss the latest trends in financial modeling, from AI and machine learning to automation and model auditing. This is your number one source for financial modeling news, tips, and tricks with your host, Matthew Bernath.
Hi everyone, I'm here with Wouter du Preez. Wouter is from the Aviation finance team at Rand Merchant Bank. He's an experienced aviation finance transactor, and we're going to discuss today, how do you finance an aircraft? What does aviation finance actually mean? And we're even going to discuss a couple of questions around what if you want to buy an aircraft yourself and maybe lease it to an airline. Hi Wouter, thanks for joining us.
Hi Matthew, thank you very much.
Wouter, I think a lot of people that are listening to the podcast might not even know what aviation finance is. So what is aviation finance?
Aviation finance could also be summarized, the term, a nomenclature to use is aircraft finance. It is not necessarily talking about airline finance, which in the corporate realm would mean that you are funding another corporate entity. In our world and space, we are already referring to the asset that backs a transaction being an actual aircraft, and how one would go about to structure and most optimally fund an asset that is very expensive acquisition for any airline, which is why these assets are often not always on their balance sheet.
So when you say they're not on their balance sheet, what do you mean by that? Do you mean that the airline doesn't actually own the aircraft?
Correct. That's often the case. In the global world today of aviation, roughly 40 to 50% of all aircraft, commercial aircraft, in use commercially for passenger or cargo use is done via operating leases. That means the airline is merely a lessee or an operator of the asset. The actual equity ownership belongs to a third party lessor or aircraft leasing company, of which nowadays there are multiple around the globe that operates very successfully and then makes sure they can meet the needs of airlines.
So these companies that own the aircraft, they buy the aircraft and then they lease, or I guess they rent them out to the airlines. So they're going to buy these aircraft, but the aircraft are really expensive to buy, and presumably they put in some equity and the bank puts in some debt. So how does that typically work, and what do you look at when you're financing the purchase of these aircraft?
You're right. Commercial aircraft are high-ticket, expensive, valuable capital expenditure items for any airline. They are denominated mostly globally from a dollar perspective. They are hard currency assets that are traded on a hard currency basis globally. They are sold by the main manufacturers, which include Boeing, Airbus, Embraer, for example. And because they are high ticket value items, to give you a good idea, today, a narrow body aircraft, meaning a single aisle aircraft, a typical aircraft you would see flying from Cape Town to Johannesburg, for example, that aircraft brand new today in the market is funded around about a $50 million level, or even $55 million level, depending on specifications. And that's a big ticket item. So it has a useful life of around 25 to 30 years. It then allows financiers like ourselves and others in the market to consider this asset from either an equity and or a debt perspective. The airline might have some funds towards paying for the asset up front, but in most cases, very few airlines have available cash on their balance sheet for such expensive capital items. So these are then funded on a long-term basis, typically for new aircraft, 10 to 15 years. If it's used aircraft, maybe 5 to 8 years, with a combination of senior debt, in some cases junior or mezzanine debt, and then if the airline themselves own the asset, a little bit of their own equity, what you would typically see in what they would call a finance lease. If it's an operating lease with a third-party lessor, that third-party lessor would buy the asset with their own funding, or again, coming to the market to leverage themselves up with some debt if required.
You talk about potentially buying a second-hand aircraft. So if a bank or somebody was to buy a second-hand aircraft and the bank was maybe to finance that aircraft, how do you know that a person's not overpaying for an aircraft? How do we value an aircraft?
Aircraft valuations are a very interesting part of the market. There's a sector called aircraft appraisal firms. There's probably 4 or 5 top ones around globally that have been in the market for many, many years and use deep statistical modeling to actually determine the market value of assets, aircraft assets specifically. These values are primarily driven by, first and foremost, the age or vintage of the aircraft, the type of aircraft, the specific model, and then you look at the factors that ultimately drive demand and supply. And that are things such as, if you're talking about an aircraft that is currently in production versus out of production, if it's in production, it means the manufacturer has an actual order book. Remember, these are not assets you go to a shop somewhere and you buy off the shelf. There's a long lead time and therefore an order book that tells the market the demand for the aircraft based on the number of outstanding orders. So these inputs, including even such things such as fuel price, etc., the engines that go into an aircraft, the quality of those engines, and the very specific details of those engines, all get filtered into a very complex model of statistical data that defines what current market values and what they call base and soft values are. A base value is just the open traded value of that asset based on the average long-term dynamics. The current market value will oscillate around base value up and down depending on near-term current market conditions. Soft value is just exactly what the word says. It is in a soft market or a recessionary down cycle, as you would call it, a macroeconomic down cycle, what a stressed value for the asset would be. These are then also forecasted out for roughly anywhere between 15 and 20 years out. And where do they get their data from? These appraisers look at all those factors I've mentioned, and they also back test this against historical data for the same type and other similar types to see how real world actual aircraft values have performed when aircraft are bought and sold, and they back test and correlate that against their own data constantly. So it's a very sophisticated, talking about the modeling world, it's a very sophisticated engine room behind a lot of these appraisers, which also of course makes for this data to be very exclusive and very expensive.
So Wouter, you mentioned something that's obviously quite key to the topic of this podcast, which is the modeling. So there's obviously a lot of statistical modeling that goes on in the background to calculate the value of the aircraft, as you said, and then a number of different inputs, fuel price, who makes the engines, presumably how the aircraft's been maintained even. But then there's also a lot of financial modeling in terms of, does buying this aircraft make sense and what should be the rental price?
Correct. The first aspect around modeling would always be the value of the asset, as we've been discussing, and all funders in the market, leasing companies, banks, etc., they would use these third-party external appraisers to determine the current value and the future anticipated values. Next up in your modeling exercise is then to come up with an ideal optimal structure, financial structure that gives you the ideal mix of debt and equity over normally the longest possible tenor with the most amount of residual value risk taken against the asset in order to maximize the economics for the airline. That really in simple layman terms means the airline wants to get an expensive capital item at the lowest monthly or annual cost, cash cost. So what we then do is we go along and we structure the ideal optimal mix of debt and equity. We look at what the market pricing is around funding for debt and equity. You would create loan amortization schedules based on various inputs and of course the desired outcome from the airline, because some airlines, for example, are not willing to take interest rate risk. So what funders would do is they would obviously, if it's a 10-year transaction, quote them a fixed rate funding for 10 years. In other instances, some airlines, normally larger global airlines that are credit worthy and very strong, would be willing to accept some level of own interest rate risk on their balance sheet, and hence they would be comfortable funding off a floating rate. These type of inputs are then modeled to determine the actual cash cost, or whether it be monthly, quarterly, or semi-annually often, of what the airline would effectively be paying, either as a rental under a finance operating lease, or purely as a repayment, which contributes normally capital and interest. The big comparison then comes in to determine how secure you are from a lending perspective. The aircraft represents collateral or security against these loans, and hence a loan to value, or as is referred to, an LTV curve of data is presented. So that is really just taking the loan values and showing them at each data point against the future anticipated value of the asset. And this is the exciting part of what we do, is every transaction lives and dies by these loan to value curves. You can be very aggressive up front, and if your asset is probably worth $50 million, you can say, I can provide funding at a very high level, close to 100% loan to value, and then over time you hopefully have debt that amortizes. So over a 10-year period, the debt, for example, would go fully amortized to zero, and then an equity gap opens up. And that's just talking to the rate of depreciation of the asset versus the amortization rate of the loan. And normally aircraft loans are structured in such a way that the loans are supposed to amortize faster than the rate of asset depreciation expected. So that's the whole premise. That's the premise then for future refinancings. It's the investment thesis behind leasing companies being willing to invest equity in this asset class, which is a dollar-based, long-term, stable, low volatility asset class. Lots of statistics globally have been done around this to prove this case, and it provides then a basic investment thesis for my equity, day one being a certain size, and in future, as my debt amortize, I have an opening up or an ever enlarging quantum of equity investment compared to the value of my asset.
So you just spoke about the fact that this is statistically proven to be a low volatile asset class, but everybody speaks about the airline industry being so volatile, and you hear about airlines starting up and airlines shutting down and having to get state funding, etc. So how does that correlate with what you just mentioned now about the asset being low volatility?
That's very true. So the anomaly in the industry that one deals with is what you would call extremely high volatility in the profit margins and cash flows of airlines versus the low volatility of aircraft values. What it means for investors is really an investment thesis, again, that is centered around the movable nature of the asset class. Unlike property and various other asset classes, where if you have credit default or constraints by the actual borrower or lessee or the airline, the benefit in aviation is you have the ability to move these assets somewhere else. And as we would talk about, you would continue to sweat the asset. You have the ability to extract or remove the capital item that was funded, and you can place it somewhere else with another airline that is not undergoing the same volatility and stress, and continue leasing this aircraft, earning cash flows for the owner. And that's really the real difference and benefit of capital financing in this arena versus many other industries where, as I mentioned with a property, if there is severe credit stress on a lessee, you can't necessarily do that much with the property. It's a fixed piece of equipment that's non-movable, and one cannot really move and extract the value out of it. So your cents return in the dollar is normally much higher, and therefore your volatility will be less.